The price of oil was up today, but energy stocks were down. Yesterday, I talked about how much I love energy continuing into 2022. So what gives? What's going on today? Am I wrong here? Well, the future is uncertain. We got to have that level of humility. Anything can change. Nobody bats 1,000. However, I think that we have to calm down, take a breath, and focus on a little bit more long-term horizon. Getting into the day-to-day is really going to drive you crazy. And we have to focus on what the fundamental outlook is, the forces, and how the chess pieces are moving, and analyze everything. One of the most important things to consider is the Fed. The Fed is the most important force in the world, clearly determines the stock market's outcome. We've seen an incredible rally because the Fed has been loose. We've seen bubbles popped because the Fed has tightened. And right now, the Fed is beginning to tighten. Yesterday, we talked a whole lot about what we liked, and we're going to talk about that again, energy in a sec. But first, let's talk about what we don't like. What we don't like is mega cap tech, stuff that has only gone up with a loosening Fed. And as the Fed begins to tighten, it's possible some of those stocks see some air taken out of them. For example, Apple is up 25% quarter to date. Has Apple become a 25% better company in the last quarter? I don't think so. If you listen to JP Morgan, the people they talk to, the high level of fear, the stock's at an all-time high essentially, about to hit 3 trillion. Their thesis is Apple has been viewed as a flight to safety. I think that's correct. And I think that's the same with Microsoft, with Amazon, etc., because yields are so low. There is no safety in yields. They are actually not safe because they give you a negative return. You're better off buying TIPS, which is Treasury inflation protected securities. Right? You'd rather have that than a 10-year bond, in my opinion. That's just me. You can do what you want. Anyways, I think that mega cap tech stuff is, and the tech that has not taken a hit is likely going to take a hit when rates begin to rise. We have to return to the fundamentals. Apple, in 2019, before the pandemic, was seeing iPhone sales slow and upgrade cycles lengthen. I'm not saying iPhones are bad products and Apple has peaked as in terms of a company and their products. They are making fantastic products. I'm recording this on an iPhone. Use Mac products across the board pretty much. But that's a fact. And they can still be a great company and not grow at an incredible rate. They've seen a boost and they got off that stalling trend because of the pandemic, because of stay at home. So many purchases, people valuing tech so highly. But my prediction is with Omicron possibly taking the weight of COVID off the backs of consumers and of the market, which has continued to occur since the first coronavirus case and is likely to continue. As the environment normalizes, I expect consumer behavior to normalize, especially with regards to Apple products. And for that trend of slowing iPhone growth, lengthening iPhone cycles to remain. For example, the iPhones are great and they get better, no question about it, but they aren't getting that much better. You know, it's not a crazy thing. That said, maybe I should get the iPhone 13 because I do record a lot of videos. Anyways, that's Apple. It's expensive. It's well above its historical valuation. Treasuries, which is a bigger market overall, bonds are bigger. The bond market is bigger than the stock market overall and has many flights to safety, is no longer that flight to safety because of negative real rates. All of a sudden, mega cap tech gets inflated because of that dynamic and because of the flight to safety, etc. Now we've got rising rates. Bonds are going to start becoming more attractive. People can go there because rates may decrease inflation, although that's up for debate. We've printed so much money. It's, what kind of effect is going from 1.4 to 1.9 really. But it will take some buyers out of Apple and move them, and Microsoft and Amazon, not trying to attack Apple, and move them into Treasury bonds as a safe haven. Now, what does well historically when rates rise? Well, energy is the best out of 16 performing sectors every time we're in a rising rate. Well, when historically we are in a rising rate environment. We have fundamental reasons to like energy. It's gone from, since the day President Biden became president, $38 a barrel to a local high of $35 a barrel, and has seen a pretty strong $10 plus or so recovery very quickly as soon as we got a little calmer on Omicron. I expect that fall was simply because of virus fears. So I expect as virus fears abate, we get back up to those levels and continue to push beyond them as the world economies continue to reopen, grow, and expand internationally. This is the worst year for new production, new exploration of oil since 1946. So there's no indication that massive supply is coming on, at least well below the historical norm, well below the 70-year, not just norm, but previous lowest level. Think about that. So the price of oil is probably going to remain high, and these companies are making good money, the best money they made in years. They're going to make more of it, and maybe they have to increase production a little bit, but it seems like they're going to be disciplined. If they do, they're going to make even more money. So the fundamentals are there. The technicals, the interest rates rise, energy stocks rise is there. And the multi-year misconception, price level depression has also occurred, leaving an incredibly optimal situation, in my opinion and in my view, for energy stocks. We'll see what happens. But I'm betting big on this area. That's how I'm constructed. So that's today's video. We're not freaking out today. We're sticking to the fundamental case. Now, today's video. Until next time, peace out.